Investors with a concentration on dividend increase are all posing the same query. Why is the SCHD ETF performing so poorly so far this year, especially at a time when the SEF 500 has made such a strong recovery and nearly all companies have been performing well? Many investors would have anticipated a price increase or recovery for SCHD, but neither have occurred. But don't worry, we'll take a close look at the SCHD ETF in this video to find out what's really going on. And the reason I believe that, at this point in the trend, this well-known dividend growth ETF may present long-term dividend growth investors with the patience to wait a once-in-a-decade purchasing opportunity. Now pay attention because we'll cover all of this and more up ahead. Please give this video a like and subscribe for more stuff in the future. Let's immediately go back to the beginning and define what the SCHD ETF is in its truest form now. Thus, Charles Schwab Investment Management Group developed and manages the exchange-traded fund known as SCHD, or the Schwab U.S. Dividend Equity ETF. It makes investments in American public markets, holding shares of businesses involved in a range of industries including energy, materials, industrials, consumer staples, healthcare, financials, information technology, and utilities. The fund invests in dividend-paying firms and focuses on growth and value equities of businesses with a variety of market capitalizations. Using a comprehensive replication technique, SCHD aims to follow the performance of the Dow Jones U.S. Dividend 100 Index. The Dow Jones U.S. Dividend 100 Index total return is what the fund seeks to mimic as nearly as possible, before fees and expenses, according to the Charles Schwab website. One of SCHD's benefits is that it is a simple, affordable service with potential tax efficiency. It invests in equities chosen for their fundamental strength in comparison to their peers using financial ratios, and can either serve as the core of or a complement to any diversified portfolio. Despite having admirable goals and features, SCHD has had a difficult year thus far. The CI 500 Dividend Aristocrat ETF is up 5.16% year-to-date, while its total return, which takes into account dividends and share price, is down 1.2%. Additionally, the ESA 500 has returned 18.87% so far this year, greatly outpacing equities that pay dividends. However, when taking a longer view, SCHD has returned nearly 72% over the past 5 years, compared to the SHEPA 500's 75% return and the Dividend Aristocrat's impressive 49% return. For long-term investors prepared to weather the storm, there may be an opportunity given SCHD's present trading level, which is still half of its 52-week range. Therefore, SCHD's current status may be something to take into account for your investing plan if you are a dividend growth investor looking for possible prospects. In terms of overall share price growth over the previous 10 years, SCHD has traditionally always bounced back and performed really well. Keep in mind that roughly 10 years ago, SCHD was trading at about $35 per share, making the even more recent $73 range roughly twice as long as the previous 10 years. Additionally, the 12-month yield for SCHD's current dividend payout is close to 3.54%. Remember that I was able to lock in a large number of shares at practically a starting yield of somewhere around 4% lately, which in my opinion is quite significant given how SCHD has been performing over the past few months. This is due to the fact that SCHD has a history of steadily and quickly increasing its dividends. At least historically, they have. The 3-year, 5-year, and 10-year dividend growth rates, EEAGR, for the Schwab U.S. Dividend Equity ETF are 12.33%, 13.92%, and 11.32%, and 11.32% respectively when considering its dividend growth and underlying parameters. Another interesting way to examine the dividends paid out by the SCHD ETF over time is to slightly zoom out and go all the way back to 2011, 2012. It's absurd that SCHD didn't even pay $1 a share until 2014, when the annual dividend was $1.4 instead. However, if you scroll all the way up to the present day in 2023, SCHD should be paying about $2.81. SCHD has been growing its dividend incredibly quickly over the long term. Obviously, relative to other ETFs, if we assume an annual dividend growth rate, or SCHD, of 10.3%, which means the dividend would double every 7.2 years. Again, this is all just estimation. Even though the 10-year, 5-year, and 3-year CAGRs are all 11%, 12%, and 14% respectively if we apply an 10.3% dividend growth rate. We can see that in 2024, investors may anticipate that SCHD will pay $3.10 in dividend. SCHD may pay a dividend of $3.41 in 2025. The ETF may pay a dividend of $3.75 per share in 2026, and so forth. When the numbers are enormous, they get big and faster because of the power of compounding. So even while this may appear completely out of the blue to some, SCHD was paying 80 cents or 90 cents or 90 cents per share in 2012 or 2013. Today, it is about quadruple that. The majority of SCHD's holdings, particularly the top 10 holdings, are the primary source of SCHD's underperformance relative to the rest of the market. This year, businesses like Broadcom, UPS, Texas Instruments, Home Depot, Pepsi, Cisco, Coca-Cola, and Amgen underperformed the market as a whole. However, I believe that SCHD will perform well over the long term for more patient and cautious investors like myself, who are ready to ride out the storm and keep on to roughly 100 or 100 or 100 or 104 businesses that have all historically paid dividends and increased their dividend payment. The next point I want to discuss is one of the main justifications I get from more growth-oriented investors for not simply investing in the SCHD 500 rather than SCHD. They argue that the SCHD 500 has fully surpassed SCHD and will certainly continue to do so for the foreseeable future. So why should investors care about dividends in general? Given that I've been a dividend investor for almost 7 years and have been fairly active online, this is one of those debates that I keep hearing. This argument sometimes arises after the market as a whole bounces back from recent lows, for instance, since all of a sudden growth investors start to look like geniuses once more. But I'll respond to this and, at least in my mind, put an end to it pretty easily. Evidently, SCHD will return significantly more cash flow than something like the SCHD 500. For investors who are more concerned with dividend income and interested in receiving cash flow payments in the form of dividends quarterly, continuously, over a variety of time frames. Yes, I will concede that over the long run, the SCHD 500 does have a chance to outperform SCHD. Despite paying a lower dividend than the SCHD ETF, the SCHD 500 may still outperform due to its higher growth rate. Having said that, because everyone has a different investing strategy and different needs and wants, I believe that SCHD will be a better option than simply investing over the long term in the SCHD 500 for dividend and income-focused investors who are more concerned with cash flow. To be completely honest, I also own growth stocks that don't pay a dividend as high as SCHD or other dividend-paying equities. A well-rounded portfolio, in my opinion, has a little bit of everything, including growth-focused investments, income-focused investments, and everything in between. I continue to believe that SCHD will be a fantastic wealth-generating tool that provides reliable cash flow on a quarterly basis and will be the ideal fit for many long-term dividend growth investors indefinitely. Is the SCHD ETF an ETF that you are currently still purchasing shares of? Or have you, like some others, entirely abandoned the SCHD an ETF in light of how it has been trading year to date? Please give this video a like if you liked it and subscribe if you want to see more content like it in the future. Guys, I appreciate you coming by, and I'll see you in the next one.